our very special show with a mega panel of the biggest minds in the financial services industry to assess the fine print of the first full-fledged budget of the Narendra Modi government. Is it a make or break budget for your money and investment? Has the government missed an opportunity to make radical changes, or are all steps in the right direction to spur investments and savings? Let's get our panel to answer that and more. We have with us, sitting with me in New Delhi, Rajiv Bajaj, welcome, who's the Vice Chairman and Managing Director of Bajaj Capital. Divya Baveja, who's the partner at Deloitte, who will be helping us understand the tax map of the Finance Minister. And from Mumbai, we have with us Kamlesh Rao, who's the CEO of Kotak Securities, Amitabh Chaudhary, Managing Director and CEO of HDFC Life Insurance, Arun Thukral, who's the MD and CEO of Axis Securities, and Sampath Reddy, who's the Chief Investment Officer at Bajaj Allianz Life. Welcome you all, gentlemen, here with us. We will also be having live callers through the show today. So if you have any query, pick up your phone and dial in, and you have a whole host of experts here with me to address that. But let's begin with first round of comments from my panel of guests. Mr. Bajaj, let me come to you first. Let us rate the budget first. I want each one of you to rate the budget. I know it's a long exercise of everyone rating the budget, but we want to understand from the financial services aspect, and more importantly, has this budget been able to drive that investment or that savings that today as a nation, you know, there are some question marks that we are seeing at. What is your take on that and rating on that basis?
Right. So for me, somebody who's in the financial savings business, and I have spent my entire career here, in the last decade, I would say this is the most progressive budget, and I would give it a 10 on 10. And that's a hard rating for me to give, and I'll give you a reason for it. One, there is a decisive shift from consumption focus. So with increase in service tax, you know, your consumption will be dearer, people will be discouraged from consuming more. There is a shift towards savings. So I can go out, I can buy Section 80C, Section 80CCD, I can save up to just under 70,000 tax. There are so many host of new schemes, gold monetization, and these tax-free bonds. So as an investor, I'm very excited, I'm encouraged to put my money in savings and contribute towards national development. So for me, this is first a very proud moment as an Indian. This is the first time I am seeing the budget first as an Indian and later as me, myself and I. Always when we open the next day newspaper in the morning after the budget, we see what is in it for me, how much more tax have I saved, you know, what can I, how can I improve my household budget from the, but today, for the first time, I'm happy there is a universal social security system. People at the bottom of the pyramid are being covered. Infrastructure funds are being set up. The whole spending, the whole subsidy mechanism also is being, you know, there is an efficiency in the improvement in efficiency in the whole process. So as an Indian, I'm proud, 10 on 10.
10 on 10, that's being generous here. What about you, Divya? Do you think it, you also want to be as generous?
See, I would say, you know, let's look at it from two parts. You know, one is a tax hat, which I wear as a consultant. Another is an investment hat, which Rajiv wears, you know. So when I look at it, I think it's more of a reformist budget, which was actually needed. If I look from a tax perspective, yes, there are certain misses, but people were expecting that, and I understand the government's predicament also, looking at that fiscal deficit and the way it is. You can't give a lot of those benefits. But yes, reformist to an extent that it has actually looked at the social security system, which was lacking in India, and which is actually needed to reach out to a common man, especially at the middle and a lower income level. So when I look at these reforms, I think it's a reformist one, and I would overall give it about 8 on 10. Not as generous, but yes, still I think it's an 8 on 10, more because, you know, more from a tax perspective, I would say some expectations have gone down, some misses, but overall, yes. Okay, I'll come on to those misses as well, and that's an important part. But let me bring in Kamlesh now, Kamlesh Rao from Kotak Securities. Do you think the investment has really moved forward in terms of spurring investment and savings? How would you rate on that parameter, Kamlesh?
You know, I think this budget is good from multiple aspects. I think the one key important thing is this is a budget of detail. I haven't seen a budget focusing on items ranging from fiscal deficit to infrastructure spending to trying and getting us to a cashless economy, addressing black money, and to the extent of even making sure if you spend money on mediclaim, whether it is mediclaim or medical expenses. So I think the great part about the budget is the nuances of detail. The second important thing is, we are all very conscious about what we do. I think the government is extremely focused about how we do what we do. So if it is subsidies, then it's important how the transmission of those subsidies go out to make sure the leakages are very, very minimal. And third most important is you have the courage to say in a yearly budget what you're going to do over a 5-year time frame, and say corporate taxes will go down over 4 years. You want to spend more money on infrastructure, but I don't have the money. If I get the money, I'll spend more money there. So all in all, I may not be as generous as Mr. Bajaj has been, because 10 on 10 will not leave any scope for improvement. So I'd give it an 8.5 on 10.
All right, Amitabh, you've always been very candid with your assessment. So let us hear what you have. And do you think that the social security or the universal social securities, but that the thought process there would give some additional points to the government?
So let me start by saying that I'll give full marks to the finance minister for coming up with a lot of innovative ideas and laying a roadmap in terms of the government thinking and vision on how they want to tackle the economy going forward. For me, the problem is that while there are all the negatives, if we look at the negatives, kind of start almost immediately, while all the positives, and there are a lot of positives in the budget, require a huge amount of execution going forward in the next 3 to 4 years. There are new laws to be passed. The corporate tax rate, if you just take an example, will happen over the next 4 years. The bankruptcy bill will come. So a lot of the positives are going to depend on the execution and what finally comes out, while all these so-called, some of the negatives which you see in the budget start almost immediately. You talked about the security net. I think there are a lot of security schemes which already exist. He has talked about 3 specific schemes and also talked about a universal social security net. So great vision. I think the rates which he has mentioned there obviously are very, very cheap, and it will definitely benefit the Indians who get it. The idea is, how do you ensure that it is translated to every individual? How do you ensure that the individual is actually paying that money? And how do you ensure that the individual actually gets that benefit which the government wants them to get? Because there is so much of leakage in the system, people don't understand the schemes, and invariably unscrupulous people take advantage of it. So great vision. So for that I would have given a very high marks, but because a lot of it is dependent on execution going forward in the future, for me it is more of 7.5, because some things which could have been done immediately, they have postponed it. I said another committee, another law. I am also quite worried that they're talking about new laws while a lot of things could have been achieved within the existing law by just amending it. So for me it's more like 7.5. So maybe I'm on the lower side than some of the others, but it's more because the execution is the key here, and it's got a long way to go.
Well, as you said, execution is the key and devil lies in the detail, and that's why 7.5 coming in from Amitabh. Let me go to Sampath Reddy. Sampath, would you agree there's also, one has to notice the entire service tax impact that could make life insurance a little dearer? And so what would you rate the government's, the finance minister's budget 2015?
Right. I mean, service tax has gone up in this budget from 12% to 14%. That's true. And, even they've increased a little bit of excise duty also from 12% to 12.5%. But overall, that is needed, because the way we are going towards, from the next year onwards, the GST is going to come into the place. So that is needed. By then, the convergence of rates have to happen. Having said that, this budget has focused more on the fiscal consolidation. If you look at the 3.9% fiscal deficit and also 3% target by FY18 is pretty much well within the expectations, I would say, even though it's extended by 1 more year. Overall, if the net borrowings also, if one were to look at it, 4.5 lakh crores, pretty much within the expected range, and it was in the same as last year's number. So overall, this is not going to lead any crowding out effect. In spite of achieving the fiscal consolidation, the government has allocated good amount of resources towards the infrastructure side, especially in the roads. The outlay has gone up from 28,000 crore last year to 82,000 crore this year. This is a significant jump. I think this is what the market was also expecting, a good amount of boost to the infrastructure sector was needed. I think this is going to come in the way. And secondly, on the Make in India side also, the government has come up with something like a plug-and-play model. Hopefully, if that is executed well, I think we could see that good growth coming from the local manufacturing side. I think overall in the rating-wise, I think intent-wise pretty much well within the expectations. Execution is going to be the key, and especially in the road side, a lot of money is allocated, but we want the those projects to move on. I think execution is going to be the key. From the budget perspective, I think I would give a rating of about 8.5.
All right, Arun, you have the last word as far as rating is concerned. We have seen the entire spectrum from 7.5 to as high as 10 on 10. So what is it that you think this budget has done for investors?
Okay, so first of all, let me compliment Finance Minister for such a progressive and pragmatic budget. So there is growth, there is inclusiveness, there is a fiscal discipline, and there is almost every section of the society, everybody gets something. So if I talk about retail investor, so he gets obviously this ATCCD, additional 50,000 or more health insurance benefits and other thing. If I look at, let's say, FIIs, the GAR is 2 years away, this FDI, FPI emerge. So there is, if you talk about hard infra, so there are more roads, there are going to be an infrastructure fund with a seed capital of 20,000 crore. If you talk about soft infra, there is going to be more colleges, IITs and other. And if you talk about healthcare, yes, even Swachh Bharat Abhiyan, even 6 crore toilets, that is also towards healthcare. So, and there are some minute things, a small thing which somebody would have missed. Like Amitabh said that there are more details, like 3,000 crore of money lying in PPF or 6,000 crore of money lying in EPF. That also is going to be utilized for some senior citizen welfare fund. So I think that's a good step, that's a welcome step. So I would, if you ask me about the rating, I would go somewhere around 8.5.
All right, well, that's the average that is coming in between 8 to 8.5 as far as our expert panel for the Finance Minister's Budget 2015 is concerned. We slip into a short break, but when we come back, we shift our focus on common man, retail investors, and how the Budget 2015 has impacted your pocket, your money. We will come back in just a bit. Welcome back. You're watching a very special budget episode of Talk Money. Let's continue our discussion on Budget 2015. But before we do that, we have a caller here for us. Well, let's hear what it is time to really hear Balachandra from Bangalore, who's joining us. Balachandra, take us through what your query is.
Hello, I have a question with respect to medical and premium. Like in the current budget,
yes,
the Finance Minister has enhanced the deductions towards this medical and premium what we pay from 15,000 to 25,000. I would like to know this particular deduction, what has been allowed, whether I can just avail it for the medical expenditure which I spend it on myself or for my dependents.
All right. Well, Divya, would you like to take that in terms of whether it can be also used for medical expenditure? There is a whole list that Finance Minister really pointed out as far as some reality check that we've seen in the exemption limit for health insurance.
See, so the way it looks at is, when I look at medical reimbursement, which is there for salaried individual of 15,000, that is totally different from this Mediclaim which we talk about. So you cannot mix the two. So my medical reimbursement limit for salary purposes remains 15,000. And this is a separate investment or that I have to go towards health insurance premium. So they are both separate things. You can't combine the both.
So, okay. So as far as this particular is concerned, you're talking about the entire premium limit really.
Yes.
And therefore that would be an exception under the ATD.
Yes, under ATD, and that is under section 17, the medical reimbursement.
So the ATD changes, and so therefore what 15,000 that you were getting for your medical insurance premium that you were paying, it now you have the liberty to move on to 25,000.
Right, yeah.
But let me bring in Amitabh and also Sampath in here to understand. Really, Amitabh, first you go. As far as health costs are concerned, yes, there is a reality check that we are seeing that you're moving from 15,000 to 25,000. Is it enough? And do you think that probably a radical change would have been better?
Well, I mean, radical change in India is not that easy, but I completely agree with you that the health costs are going down on average between 15 to 18% per year. So this jump was almost a fait accompli, that you had to give this premium to just maintain your standards of health insurance you can get. But yes, the government is recognizing the fact that health insurance is important and they need to promote it. Over and above that, I think they've brought in a very significant change in terms of ESIC and how that can potentially be replaced with the health insurance. I do very strongly believe that ESIC does not work. I think people do not go to the medical facilities maintained by the ESIC organization because they believe that they don't provide them the right medical facilities. Now they potentially would have an option to buy a health insurance against the ESIC money and actually get the kind of facilities which they want, obviously at a price, but that will also become possible. So I would say that the bigger change and a more subtle change and a more visionary change is this replacement of ESIC, which might be possible going forward in the future, and that will promote the health insurance industry in a very big way in India, rather than this small change which they have done of 15 to 25. It's good, obviously it's welcome, and I think they've done more for the senior citizens where the health costs are higher. But the ESIC change in my mind is a bigger and a long-term change which will have a huge impact and a positive impact for the development of the health insurance industry.
All right, Sampath, your thoughts. Do you think that at least are you getting a sense that the government is realizing that 15,000 is not enough? We're moving to 25,000. We don't have a window right now to probably do that radical change, and as you say, it's not easy to do so. Amitabh pointed out right now. Would you agree with that?
Yes, I think it's certainly a welcome move, from increasing the limit from 15,000 to 25,000. It's, certainly a good benefit from the perspective, to the tax saving perspective. And overall, in the country, in India, especially the medical expenses have been growing at a rapid pace, and overall our expenditure in terms of the medical side, medical services side is much below, related to the global standards. So we need to, ensure that our life insurance, health of the individuals in India is covered pretty well. I think in that direction it's certainly a welcome move. Yes, it's a positive development. Yeah, the more could have been better, but I think so far this is a very good step.
All right, let's go across to our next caller who's online, Santosh Belavadi from Bangalore again. Santosh, what is your query?
This is Santosh here from Bangalore. I am 34 years old. I am much more interested in infrastructure bonds. I want to know more about the infrastructure bonds, and is there any risk in it, and how secure they are.
All right, let me first bring in Rajiv to address that, and I'll also get our other guests to answer that.
Yes, so Santosh, infrastructure bonds are something which are very safe. And because they are issued by the government institutions, so from rail, road and irrigation sector, you'll be getting tax-free bonds, and this is always very welcome because you can get on a post-tax basis 1 or 2% more than the bank deposit, and every investor looks forward to enhancing their return above bank deposits, because if you see the last 20-year return of bank deposit, it barely covers inflation. As an investor, your first obligation to yourself is that you should beat inflation at least by 1 to 2% to just maintain or slightly improve your lifestyle. So and I think infrastructure is the beginning. Gold bonds being available is another benefit available to investors like Santosh. So gold deposits, gold bonds, I think that is something very important in this budget. And people like Santosh, people like you who are young, just 34 years of age, you should be looking more at the NPS, the change which has happened in NPS. Instead of putting your pension money in EPF now, you can now put it in NPS. You have that option. And I think that's a big advantage for you. Somebody like you has 25, 26 years to go for retirement. Just imagine, the kind of growth we are going to see in our country. We are talking about double-digit GDP growth at 10% plus. And even if our stock market gives you 1.5 to 2x of that, which is 15-20%, you can imagine, instead of getting 8.5% in your EPF, if you get double of that, just imagine how much wealth you will accumulate as an investor. By the time you retire, you will have a huge corpus. So as an investor, there is a huge new gamut of savings avenues available, and I'm very excited if I, in my shoes as an individual investor.
All right, taking a cue from the point that you were making, let me bring in Kamlesh and Arun. The entire big headline that we think as far as the budget 2015 is concerned is the government approach to address gold and gold monetization. That's something that the finance minister spoke about. I want to understand from you that how critical will it be going forward? I'm not saying it will be an immediate translation in terms of directing the savings of young India towards other investment avenues, towards equity market, towards debt markets, because the finance minister was pointing out very clearly that the young generation may not be the one who will have that kind of attachment to gold perhaps that for years we've seen in India. Kamlesh, you go first.
Pril, gold I think is a evergreen part of an investment portfolio. It's been like that for so many years in India, and therefore I think two things that have happened. One is to say you can monetize gold without having gold. I think is a brilliant thought, because it would be unlike in gold ETF where the underlying is still gold. If you do a gold bond without the underlying being gold, you actually can get gold linked returns without really wanting to buy into the gold. So I think it's a very welcome step, and from that point of view the younger population would definitely be attracted to get into an instrument like that. The house we still have to find out and work out. We don't know the final detail as yet, but a gold bond is a very lucrative form of investment if it is linked to price of gold over a period of time without really having wanting to have the underlying asset in gold. B is the gold deposit that he spoke about, the change in terms of saying that you can, a gold lying in your house can actually be there with your bank. It can earn you like a fixed deposit rate which you otherwise earn on physical money that you put with the bank, and banks, he said, will be allowed to do this, which in turn will be used by the bank to actually provide metal loan to the jewelers. So it's like a win-win situation for both. The gold lying in your house can earn you interest. So I think from a point of view of a customer, it looks like something that wasn't earning you any returns sitting at home is now going to earn you return. And if you still want to be in the gold category without wanting to have underlying gold as an asset, that is also possible. So on that side, I think the gold monetization stuff is very, very good for customers, and definitely worth having some part of your portfolio in that going forward.
Arun, your thoughts on the same?
So first of all, actually there are two things which have happened. One is that the old gold scheme is replaced by the new scheme where you can get some interest and maybe jewelers can take loan in the metal accounts. And the second is the sovereign gold fund, which will again give you a fixed interest. So these are the two things which have happened, which is a welcome step. As Kamlesh said, yes, at least now you will get some return on the gold. But you are asking about the young investor. So one point to be made here, that obviously gold has to be part of your portfolio, but it has to be a very small part. Still, I think there are plethora of financial instruments which will give you a much better return. So obviously equity has to be part of everybody's portfolio, like our caller called up, the 34-year-old. Obviously he should invest in tax-free bond, but whether he has done some allocation to the equity, that also I think he can check. Tax-free bond obviously is one of the option, but if he is in the highest tax bracket, then it makes sense. But if he is in a lower tax bracket, maybe he can have another options also, because finally you are going to see the returns after tax. So the asset allocation has to be there. The gold has to be part of your portfolio, but that is what we suggest, around 5 to 10%. Now that 5 to 10% will also earn you some interest. So that's a welcome step. And another welcome step is that our own Indian gold coin with the Ashok Chakra, I think that is what we should welcome.
So that has an emotional value attached to it. But Arun, if I were to, we were to tell our investors, though the contours are still awaited, with the new avenues of gold monetization, whether the gold bond versus a gold ETF, that still is something that is an important instrument that we have now. What would your advice be?
I didn't get it.
The comparison between gold ETF and gold bonds.
Yeah, so as Kamlesh said, is that gold ETF you have to have, it has to be backed by gold. If you look at gold ETF, again you are not getting any interest. And if you look at last few months, so there is a redemption, there is an outflow of in the gold ETF schemes, around 2,000 crores have been taken out. So clearly it tells us that today that investors are not interested in gold ETF. Nobody is going to invest further in ETF, and gold monetization, this where they get some interest, that is obviously a better step and better option available to the investors.
All right, with that, it's time now to slip into another very short break. We will continue to decode budget with our panel of experts when we return in just a bit. Welcome back. You were watching a very special budget episode of Talk Money. Let's continue our discussion on Budget 2015, and we have another caller here with us from Lucknow. Joining us, Amit Srivastava. Amit, take us through your query.
Yeah, hi. I'm 37 years old and my annual income is about 16 lakhs. Now, I have two questions. The first question is about the tax saving part. Now, there is a confusion. When you mention NPS, the limit has gone from 1 lakh to 1,50,000. But the ATC overall limit is about 1.5 lakhs. So there is some kind of confusion which if you could explain. The second thing that I would want to know from your experts would be that I am expecting some increment in the next year and some other incomes. So I have a sum of rupees 3 lakhs additional with me. So what would be the right avenues to invest that money, which is more on a tax saving side than on the risk side, or risking them on equities?
All right, Amit, we'll just get your query addressed. Divya, first, as far as the tax side is concerned for NPS, so it's basically outside of the ATC in the sense of ATCCD or E, if I'm not D. Okay, so take us through that.
Yeah, so Amit, the question which you have asked is about the overall limit of 1,50,000 and the 50,000 being increased. So what has actually happened is that under section ATCCD, there was earlier a limit of 1 lakh. Now that 1 lakh limit has been omitted. So what the law says now is that an individual can contribute up to 10% of salary, or if you are not a salaried person, then 10% of total income. So the limit which was there of 1 lakh for this category, that has been done away now. Now additionally what they have said is that you can invest up to 50,000 more in NPS, and this 50,000 will be outside the purview of 1,50,000, the limit which is there under ATC.
And as you pointed out, that the one miss which you started your conversation with and for NPS is that the EEE is not something that is granted, and that would impact for monies really to trickle in as far as the NPS side is concerned.
Absolutely. So NPS right now is taxed at EET, which is exempt at the time of contribution, exempt during the accrual stage, and taxable at withdrawal. So I think if they really want to make NPS a success, it has to be made an EEE, so that when people invest and when they get the money back, that time also it should be exempt, the withdrawal. Yeah.
All right, let me bring in Sampath to address his second query, in which Amit pointed out is that while he has exhausted his entire limit as far as for the tax saving exemption limit is concerned, and we all know that with everything clubbed together, from your interest home loan to your tuition fees, etc., there is a very limited window available. So what should investor like Amit do in terms of what option and avenues that they would have for investments?
Right, given that Amit is about 37-year-old, and he should consider certainly good amount of allocation towards equities. That is one, and equities certainly anything more than 1 year of holding period certainly doesn't have any tax. And outside of that, this time government has come out with the tax-free bonds for the rail and road sector and irrigation side. I think some of those companies will start issuing the bonds in the next 1-2 months. I think that's another good avenue going to be the tax-free bonds. And thirdly, if you have a horizon of 5 years and so on, you can look at insurance products as well. With the 10 times life cover, they also provide good amount of tax savings. So these are the 3 avenues one should look at it.
All right, now moving on to another important query that I have for Kamlesh and Arun, and I will of course get Divya's thoughts as well on it, is the entire stance of the government and a clear indication that is coming in that the direct tax code is dumped. How do you think that will impact the investments, remember there was a whole question mark as to, long-term tax, capital gains tax, what happens to that? You had your ELSS in that category, whether they will come out of the tax saving avenue, etc. So with direct tax code gone, is there a sigh of relief, or do you think that a lot will now have to be tweaked as far as other avenues of the taxation concerned to spur investments and saving? Kamlesh.
Yeah, like the investor asked, I think the other good part about NPS is you have a ability to allocate 50% of that in equity, which I think in today's time will enhance. And if you look at the returns over the last 1.5 years of people who put money in NPS with 50% maximum allowed as equity, I think the returns are looking pretty good. On the tax front, otherwise, I am saying whether we had a worry whether long-term capital gains will come in on the capital. That's not happened, so that's a good sign. ELSS, all the instruments that they've created from a investor point of view, I wouldn't see too much of tweaking of that happening going forward, because finally one of the key elements of the budget, the way I see it, is to try and see whether can that be a consumption-led demand. And therefore, if you look at, whilst everybody would have wished for the exemption rate going up from where it is today, more money has gone into the hands of the customers by virtue of the 1.5 lakhs, 2 lakhs of housing loan. Your transport allowance has gone up from 800 to 1600. So that means some more money, 50,000 more on, say, the NPS side. Your EPF, which is a contribution that you had to make from your side as well as the company, is now optional. I mean, you may decide not to make it from your side, though from the company side it is mandatory to make. So the entire thinking process is to say how much more can I give into the hands of the consumer. I don't think anything will get tweaked around to basically dampen the whole sentiment of the required consumption-led demand. That is what is the government looking for.
All right, Divya, direct tax code. I mean, when it was decided that we'll probably be looking at it, and more, I'm talking more about from the personal finance aspect or a common man's, the implication of taxes on him. The entire issue was, to uncomplicate things, and but what we saw as a piece of the legislation was complications and confusion that would have arisen. So it's a good move, and how do you think would it impact?
See, when we look at direct taxes code, it had certain glaring provisions, whether it was in terms of relooking the way a capital gain tax is computed, or whether it is looking at revamping your ATC and having only specified avenues. And so, but when I look at it now, I think most of the provisions, the law is well settled, and that's what even Finance Minister mentioned, that there is no need to look at a DTC because most of the provisions are already incorporated in the law now. So I don't think there will be any change towards DTC or move toward DTC. I think it's a good move because you don't want to start the law fresh all over again, and people start rebuilding or rethinking on what they have invested and how does it move forward. So to that extent, I think it brings clarity in the minds of people. So I don't think that's something to worry about now.
All right. Let's take in our next caller who's joining us from Jabalpur. Manraj is here. Manraj, please take us through your query.
Yes, my question is, I'm an entrepreneur and student at the same time. I have invested money in SIPs. I still have window for more tax saving. What alternatives do I have?
All right, so an entrepreneur and a student. So what does this budget brings for him and his query? Rajiv.
Yes, so as an entrepreneur and as a student, what a lovely combination that is. I must compliment you first. Yeah, you are looking to wealth creation, and this is absolutely the right time, right stage and the right time as a country for wealth creation, because in wealth creation you need a good, clear economic outlook, you need good policy direction, you need a reformist government, everything is in place. So SIP is something which you should continue to build upon, and this budget has increased your avenues. So you can put that additional 50,000 in NPS under section 80CCD and save and buy health insurance as well, even though that was not your question. So as an investor, earlier you were able to save up to 50,000 tax. Now you can take that tax saving up to 70,000. I think that's a one big plus. So, look at this another way. For every 1 lakh rupees you are investing in the markets, by saving up to 30% tax, and I'm assuming you are in a high tax bracket, your 30% downside risk initially is underwritten by the government. So it becomes the encouragement for you as an investor to step in. And worldwide, whether it is UK, USA, peers like you, any person who's investing for long term and their retirement provision, they are encouraged by the tax saving which they get from the government. So this is the first time we have taken a very progressive step as a government to bring in people and invest for long term, and people like you who are investing in SIP, this is the right time for you to up your SIP investments.
All right, let me get a sense from Amitabh, overall on the investment options and the insurance that comes in. Amitabh, we have seen for over the years that yes, tax plays a very critical role as the first probably trigger that leads to a lot of people wanting to look at insurance, whether it's a right approach or wrong is something that's of course something we can debate on. But in terms of a long-standing request of the insurance industry that please keep insurance a separate category to get more people to come and invest in insurance. The entire way we have seen ULIP becoming a popular avenue, then because of probably over regulations not losing their flavor, and now it seems that with the markets going up, some interest going forward. Take us for the investors like Manraj that we just spoke with, that how critical it is for them to have insurance in their portfolio, and do you think that the budget need to bring in some more specific issues for larger insurance needs, for triggering that larger insurance move?
So Priyal, a number of questions in what you just asked. I mean, it was very obvious from the three callers who called you that, tax seems to be, and tax saving seems to be a pretty important driver for all these people who are, looks like, obviously some of them, two of them mentioned their age. The last, Manraj, looks, the way he was talking, he looks, obviously he's young, quite young. So for them, tax saving seems to be important. But, the analysis and the research shows that India is underinsured. And a lot of these very young people, while they're very focused on returns and tax savings, they're really not looking at how do they really insure themselves for an event which they're really not prepared for. So from that perspective, the insurance industry has been asking for a couple of things. First is obviously a separate limit for insurance so that it incentivizes people to invest more in insurance, because India is underinsured and a lot of the young people are not looking at insurance as a very important part of their overall investable surplus in what they kind of invest in. I also at the same time fully understand that the finance minister has limitations and constraints in terms of how much they can put towards what category. So this time the focus has been more on pension and creating something at the end of your working life, kind of a corpus which you can use to live a certain lifestyle. So the whole focus is on NPS, the whole focus is on increasing the limits on NPS, giving some flexibility on investing between EPF4 and NPS, and because as Kamlesh for example mentioned, that a part of the 50% of the NPS money can be invested in equity, it is also allowing hopefully more money to come into the equity markets than before. As even Rajiv mentioned, SIP is a great opportunity. We are at a perfect cusp in terms of how India could potentially take off from this point. As Mr. Finance Minister said, it's time for India to fly. Now, if India does fly, even if a little bit, and given how India has been performing against all of the other emerging economies, if Indian economy was to do well over the next 5, 10, 20 years, then it's a perfect time to get into the equity markets. Get into the equity markets by whatever instrument you want. It could be through mutual funds, it could be through, insurance, where you mentioned ULIP. ULIP could be another way to get there. You talked about ELSS. If people who are risk averse could use the tax-free bonds or EPF4 or debt funds. So the avenues which are potentially available to an Indian investor are huge. Even to young people, because they have limited surpluses, I think they should focus on some instruments, not kind of spread themselves thin in terms of investing in too many instruments. The objective is that you want a part of your corpus in fixed return kind of instruments, and you want a part of your corpus definitely invested in instruments which will play on the Indian economy, which will actually give you a much larger benefit if the Indian economy was to do well. And that's exactly what I'll suggest to the individuals who have been calling. And foremost, and it's very, very important, somebody did mention insurance, it is important to cover yourself somewhere. We are leading a lifestyle and a pace where people do have unexpected events in their life. It is very, very important that they put a small amount of money away. Even if you look at the whole social security net which the finance minister has talked about, he's talked about a scheme for accidental death, he's talked about a scheme for natural death, he's talked about, you know, potentially increasing something on the health side. So it is, again, the whole social security net is all about what happens if you're not there, or what happens if you become incapacitated and you can't work. And it is very important that it doesn't even apply to poor people who are working, who are earning money, also keep a part of their corpus for things of that nature. So a lot of instruments, a lot of possibilities, a lot of tax benefits which are given for various instruments. Anyone who's a bit confused should reach out to, you know, programs like yours, or to, you know, friends, family, or, you know, consultants who can very quickly guide them in terms of some of the alternatives which are available to them.
All right, time now to slip into another short break, but after the break we will continue with our discussion and decode Budget 2015. Keep watching Talk Money. Welcome back. You're watching a very special budget episode of Talk Money. Let me first ask you, Rajiv, with regard to real estate and something that again attracts a lot of investors. What is it that this budget brings? Some sort of issue in terms of you cannot give in the cash, and that's the right way to go. Right.
So Priyal, I have to tell you, I've been in this business almost 25 years. And one of the demons I've been fighting against when you talk to investors and potential investors, the answer you get is they are not making any more land. So I think finally I've seen in the last 6 to 12 months, and especially with this budget onwards, this mindset change is coming, that there is wealth creation possibility beyond property. And with, you know, black money laws coming into place, with this cashless society we are trying to create, any expenses about 20,000 in this budget onwards, it has to be a check or a debit card payment. This is a decisive move that people will not be able to, that generation of black money is slowly going to be passé. And yes, people will find shortcuts in the interim, but the laws are going to be so stringent, people don't want to go behind bars. So it will be a compliant society. That means a decisive shift from physical savings like real estate and gold to financial savings. And I think that is very good, because these are unproductive savings. When you buy land, it is not helping the nation. It is not doing nation building. Whereas when you invest in bonds, you invest in stock markets, ultimately infrastructure of the country, the corporate sector is getting built. It is creating jobs, employment, growth for everybody. So it's good for the investor and good for the individual. So it's a very, very important and decisive move that the household savings, always the mix has been 50-50. 50% has been in physical assets and 50% in financial assets. In the last 5 years, it became skewed 2/3, 1/3, whereas almost 2/3 of money was going into property. Now that is going to come back. And what people need to realize and know, that property is a very good avenue for creating wealth over long term, but it is illiquid. There is no guarantee that you'll be able to take out money. Whereas stocks have given equal opportunity in a country like India. We have mature stock markets, and you can invest in corporate sector and ride their earnings growth. If you can't become an entrepreneur yourself, you can invest in somebody else's enterprise and grow. So this is a more legit way of creating wealth. And it's a very inclusive way. You can start with an amount as small as 100 rupees a month in systematic investment plan of a mutual fund. All right. Divya, one thing about budget always is, what has become costlier, what has become dearer. Service tax increase, what it changes, key things that it changes. Just take us through that very quickly. Okay.
So service tax has gone up to 14%. And there's also a proposal for 2% extra for Swachh Bharat Cess. So what it means is that, my restaurants, if I go out to restaurants, that becomes expensive. If I have to go to amusement park, that becomes expensive. If I have to take an insurance premium, that becomes expensive. So the cigarettes become expensive. People who like to smoke, or, aerated drinks become expensive. So I think it has an impact on your indirect way of cost going up, and which has to come from the consumer's pocket now.
All right, Sampath, the impact of service tax is also on life insurance premiums, and do you think that would be a bit of a dampener?
I mean, this is going to be there in across all the service industries, including life insurance and telecom and all banking and all kinds of services. So in net, I would say it is it certainly will be passed on to the consumer. I don't think it will be a big issue from the service tax increase perspective. But in terms of overall what has gone up and what has come down, especially what has come down. Things like some of the inverted duty structure has been removed, especially LED and LED imports, LED parts and LED imports. For example, LED TVs and LED lights, their excise duty has been brought down to 6%, and any of the LED panel parts and etc. imports, there the import duty has been reduced from 10% to the nil. I think this segment is certainly going to be is going to see a good growth and boost. I think this is the only one I would say is a clear winner. And in terms of import duty, again in the steel products there has been import duty and increased because that's especially to curb the anti-dumping from the Chinese steel producers. So that is another area where steel prices are going to go up. Otherwise, I think broadly most of the things are very much within the expected range, and it is going to have a uniform impact, like service tax and excise duty gone up is across the board. Corporation profit tax, though it is not going to be impacted in this year, but whenever every year, I'm assuming that 1% reduction in every year for the next 4 years, then that's
all right.
That's going to move up the earnings by about 1.5% or so. That's going to be the corporate earnings growth.
All right. Let me quickly get in. All right, Sampath. Let me quickly get 30 seconds to Arun and Kamlesh for their last comments in terms of what next the government can do outside of budget to get more investments into equity market, the dire need of the nation. Kamlesh and Arun, very quickly.
No, I think the scope is left for pushing more money into infra. I think is a key requirement. Consumption-led demand is going to be key for us. So I'm saying what he has to do in the equity markets in the last 6 months or 3 months, I think a lot of it has already been done. I think what will drive markets now is going to be corporate earnings. And if we see the interest rates scenario coming down from where it is supposed to be, a 50 to 75 basis points, that could be a huge plus for the equity markets.
Arun, to you.
So what we were talking about, a credible budget. So that I think we have seen that. So credible budget obviously will accelerate rate cycle. So we are into a lower interest rate trajectory. As Kamlesh said, that earnings are almost at the bottom, it's bottomed out. So hopefully from here on the equity market also should look up well. And another thing what I wanted to talk about, some concern, as you said, DTC has gone or something. So what's in a name? So investor today is very smart, so they will know that yes, if there is a gold monetization scheme, they will go there instead of going to a gold ETF, and more money should come to the equity market. That is what we hope should happen now, and that's all this best for the country.
All right, with that we've absolutely run out of time, and thank you all gentlemen, thank you Amitabh, thank you Kamlesh, Arun and Sampath for being there, and also Rajiv and Divya sitting with me here in the Delhi studio. Thank you all gentlemen for being here and guiding in terms of decoding the budget with me at Talk Money, and we hope that while the rule of financial planning and your investments do not change, you look at conscious decision of planning for your investment. Thank you.